cultural differences sound like minor things, but if you can build that throughout a company and hire people not with $1 million salaries, but equity in the company because they're going for the mission and willing to sacrifice today's salary for the chance at revolutionizing the largest undisrupted industry on the planet, like you really have an opportunity to create a company that's filled with missionaries that are actually going to help change the industry. It's currently priced like a Russian bank. If Opendoor can survive this downturn and manage either break even or profitability, the thesis that the company is going to fail goes away. That's when we really start to see some fireworks in share price. It's important to sort of start with the basics of like the actual dynamics of iBuying. So if you're not super comfortable with sort of the mechanisms of the iBuying business, I think the first thing to know is that it's both capital intensive and razor thin margins. So like at like terminal gross profit margins for Opendoor, if they're crushing it, right? That would be like 15 to 20%. That would be incredible if Opendoor could get to 15 to 20% gross profit margins, which, you know, if you invest in software companies, that's a pittance, right? It's like basically nothing. And Zillow and Redfin are these growthy search companies with 80+ percentage points of gross profit margin because it's all ads. It's all incremental profit margin, right? And so these companies are competing against Opendoor. And I think the original thesis was, oh, these companies have top of funnel, right? It's going to be cheaper for them to acquire customers and, you know, they can use their more profitable business lines to fund iBuying against Opendoor. But the truth, like that just didn't happen. And even in my first article, which I wrote about a year ago, I said, I question whether companies with soft serve ice cream stations and nap pods can compete with a company as frugal and disciplined as Opendoor, right? Like Opendoor from its very existence was built upon this foundation of razor thin profit margin. And they even have this cultural value of basis points for breakfast. They eat basis point for breakfast, which is 1/100th of a percentage point because they need to save all of those basis points just so they can survive and not lose a bunch of money. And so I think, you know, when Zillow and Redfin came in, it's because they didn't want to be displaced as this demand aggregator, this like marketplace, right? And so they're like, okay, we're going to participate, but then they got a little ahead of their skis because they relied too much on the tech and not as much on the operations. And building an atoms and bits company like Opendoor has, which is both boots on the ground and software, is really hard. And very few companies have ever been able to do that, right? It's like, you know, Tesla, Amazon, Apple are like, you know, great examples of companies that have done that well. But you think in your head, you're like, of course, like hardware and software, there's a bunch of companies that do that. Very few do, and very few do it well. But if you can manage a company with a razor thin gross profit margin successfully, it's a huge competitive advantage because no one will be able to come in and take that margin away from you. Dovetailing off of that, if I've got 80 percentage points of gross profit margin as a company, if I'm Zillow, right, and I've got 80+ percentage points of gross profit margin, I don't value each of those as much as a company who's like, we have 10 percentage points of gross profit margin. We're only ever going to have 10. And if we're doing well, we're going to have 10. And to survive, we need like 9, you know, like, so the difference in value attributed to every basis point for a company like Opendoor from day one for every employee that's ever hired and all the culture behind that organization, right? From centralizing operations to not having free lunch in, you know, in this big, expensive, like tech hub, right? It's just, these cultural differences sound like minor things, but if you can build that throughout a company and hire people not with $1 million salaries, but equity in the company because they're going for the mission and willing to sacrifice today's salary for the chance at revolutionizing the largest undisrupted industry on the planet. Like you really have an opportunity to create a company that's filled with missionaries that are actually going to help change the industry. And I think Zillow just came in and they're like, okay, we're going to distribute resources to this. And, you know, we've got search and we already invest in it. It was all wrong. It was all the wrong flavor for what actually is needed to succeed in a space like iBuying.
So as I understand it, there's a pool of capital and they're able to buy, tens of thousands of houses or maybe thousands of houses. What does that mean economically for the business?
So virtually 100% of the homes that Opendoor purchases are debt funded. So like debt is the oxygen for a company like Opendoor or a firm to operate. So they don't use any of their own cash really to finance home purchases. They have staggered lenders, a portfolio of lenders, because the appetite to lend against short duration residential real estate in the United States is huge. And so they have the best lending rates in the industry. Obviously, some of those, their non-fixed rates are going to increase with interest rates increasing. But at the same time, it's actually not going to affect their business materially because they're passing on those costs to the consumer. And so like, for example, if interest rates increase by 1% this year, which they're not, it's gonna be more than that. But if interest rates increase by 1% this year, and Opendoor turns its inventory 3 times a year, then for each home that it purchases, that 1% increase in interest rate is only going to impact the price of the home by 33 basis points, right? So 0.33%. And so to compensate for that, Opendoor is just going to offer consumers 0.33% less for their home. And so in that way, Opendoor is going to be able to navigate these cycles without too much excess interest cost, because they're trying to hit this narrow set of goalposts. And their whole model is really like, in any given scenario, we can flex so that we can still be inside these contribution profit margin targets.
So another interesting one, you wrote, I think Luca, you mentioned it earlier, at the time of Opendoor's IPO, 1 in every 2,300 US home sales occurred on their platform. And as of this year, 1 out of 130 home sales are through Opendoor. Can you comment on the Opendoor's growth to date? And then off the back of that, what the bull case for Opendoor regarding market share might look like?
Yeah. I mean, one of the original reasons that I got into Opendoor was the growth is absurd, right? Like a company that can scale operations and technology. It's one thing to scale software to that level, because it's all just incremental. But to scale an operations heavy company like Opendoor from 750 million in sales in Q1 2021 to 5.2 billion in sales Q1 2022 is pretty flabbergasting. Like it's pretty unreal to see that type of growth. Part of that is that Opendoor was scaling from basically standing still. Like they had sold off most of their inventory during COVID, just because of it was unclear, how it was going to affect the housing market, and a lot of necessary processes like municipal courts and things like that were closed down, so they couldn't even operate the business. They had to move from in-person visits to virtual visits to inspect the house. I mean, all of these things that really crush an operations heavy business, they were able to navigate. But the idea here is that it's still day one for Opendoor. Like they just launched their 51st market today. They just announced it, and they have a long-term goal of hitting 100 markets. But even today, they're in 50 markets, and 30% of their sales are in 2, in Atlanta and Phoenix. And so, they're crushing it in those 2 markets. And it just sort of emphasizes how much opportunity, how much white space opportunity is ahead for them to just incrementally growing a little bit more in each of these markets that they're currently operating in. I think it's not unrealistic to assume that Opendoor is able to achieve. I think it's very likely that Opendoor will achieve 5 to 10% market share in its 100 markets. And that puts it in the $200+ billion a year revenue category. And that's just like incremental growing and continuing to launch in these markets where there's no other competitor. Like 0 other competitors exist in that space, which is pretty amazing.